think the key, though, the point I think to make, though, is that even in very uncertain time periods, whether the last 12 months looking at in terms of where interest rates are going to do, debt ceiling, government shutdown, commodity prices moving around, right? Lots of uncertainty, that we still saw stock prices in total in the last 12 months go up quite a bit. I think the key takeaway is that these short-term time periods, while it's important to understand what occurred and how we got into these, that it's not always a great predictor of what's going to happen in the next period.
Right. Let's get into markets.
The market bottom was October 12th of 2022. So as of the day of this recording, we're nearly a year off of that. So stock markets from that standpoint have really done quite well. In fact, if we looked at some of the recent data, this is the one-year returns through the end of this last quarter. So through September, the stock market's up 20% in the U.S., international's up 24%, even global real estate, that's up about 2%, and bonds are up not as much, and U.S. bonds are up about 0.5 to 2/3%. It's good to see portfolios have benefited from that by owning stocks. If you look at the quarter, we had a lot of red on the quarter. I think the key takeaway, though, is there's a lot of similarity what happened in this last quarter to what happened in all of last year. So to rewind through, for this last quarter, U.S. stock market was down about 3%. International was down about 4%. Global real estate, 6.5%. Even bonds, because as interest rates rose, were down in total. So U.S. bond market was down about 3.2%. Historically, stocks, whether it's U.S. stocks, international stocks, just talk global stocks broadly, have outpaced inflation better than other asset classes. The difference is that stock markets are more volatile than bond markets typically. And so when we think about how do we kind of think about investing for the long term, right? We need to own stocks in a portfolio, we believe, to outpace inflation. Now, the downside of that is that there can potentially more price volatility.
This chart here, this U.S. yield curve, let's start with the blue line. What's that one?
Yeah, so the blue line we're looking at is most recent yield curve in the U.S. Treasury market. So it's comparing the yield available on short-term interest rates, like a 1 or 3 month Treasury bill, all the way out to a 30-year Treasury bill, or Treasury bond, that is. Now, the yield curve is inverted, meaning that shorter-term interest rates are higher than longer-term interest rates. That's a bit unusual. We don't typically see that inversion where the short term is higher than the longer term. What we're also looking at here, too, is comparing where we're at today compared to where it was at the start of the year. That's the green line, as well as 2 years ago, December of 2021. And that was before this most recent kind of cycle of increasing interest rates. And so you can see with that black line on the bottom, right, in the short term, interest rates were basically around zero, in that time period of December of 2021. Right? It seems like a long time ago in terms of interest rates, because now rates are a lot higher, especially in the short end. Went from basically 0 to 5.6% in a pretty short amount of time. Zooming in on the longer term picture, looking at 10-year Treasury, for example, go back to the 1980s. Right? Right now, I mentioned before, we're in that, for a 10-year Treasury right now, it's at about 4.6%. Rewind back to the 1980s, we were in that range. Zooming in here, we were probably in that, it's 10% plus for the 10-year Treasury. If we went back to the 1950s and looked at what's the average been over that time period, the average for the U.S. 10-year Treasury yield has been about 5.76%.
Not too far from where we are now.
No, and importantly, it's higher than where we are now. So even though rates have gone up a lot lately, it's still actually below the longer-term average going back to the 1950s. It doesn't tell us if rates are going to go higher. That's not the point of this. The point is to kind of to digest that interest rates are higher, but that it's not that we're at an all-time high now or at a really high level. It's just that we got used to a really low level for a long time period. If we looked at the last really 15 years leading up to 2021, even into 2022, right, investors mostly had to think about stock market volatility. Right, interest rates were low, bond prices didn't move around much, and stocks generally went higher. But there was some volatility in there. That was the main risk that investors broadly were looking to diversify, if anything. Now going forward, it could be different, right? Inflation's higher. We still have price volatility. There's two dynamics. There's both inflation risk and there's price volatility that can come into the mix.
At this point.
Yeah, the unemployment, or the jobs market rather, has been pretty resilient this year. I think coming into this year, more people expected the jobs market to deteriorate a little bit, and it just hasn't really been the case. It's been pretty strong. In fact, unemployment levels are still pretty low. Unemployment's at 3.8%. That's pretty low. We often hear in terms of an unemployment or jobs market tends to deteriorate prior to a recessionary period, and we just haven't had that. And so from the Fed's perspective, when the Federal Reserve over the past several quarters, in total have been increasing interest rates, this has been the last really year and a half, a part of that, a reason they've been able to keep raising rates even into this year is that the jobs market has stayed really strong. They've had room to raise rates, to slow down the economy, and it hasn't really impacted the jobs market, at least not yet. The markets this year in particular have looked past the debt ceiling and then the potential government shutdown, meaning there has been some kind of jitteriness in the market leading up to it, but not a lot, such that the market is expecting the outcome to be such that it's either the debt ceiling is going to get passed or kicked down the road, or that they're going to avoid a government shutdown. From an investor standpoint, we've seen these over and over throughout time where either we're threatening for a government shutdown or a debt ceiling that is being debated. We try to encourage people to look past that. To us, it's not a matter of if, but when is it going to get passed? And while there might be some uncertainty, it's unlikely that the government is going to intentionally default.
Yeah, let's talk about how the inflationary pressure is kind of in play with this.
Yeah, inflation is very important, of course, because it impacts how we spend and how we save, how we consume, right? And so inflation can erode or does erode purchasing power as well as your what we call nominal returns. So I'll give you an example. If the 10-year Treasury rate now is at 4.6%, and if inflation is at, call it 4% in simple math, right? That means in terms of a total return after inflation, we're at less than 1%, if that was kind of simple math. The reason that's important is if we look back to the 1980s, we had higher interest rates. We also had higher inflation. And so the real return after inflation, the inflation-adjusted return, was not in that 9-10%. It was much lower than that because inflation was higher.
So what I think is interesting about this chart is that over 5 years, we're up over 20% for inflation.
Yeah, the important thing to remember is that inflation, the traditional measure CPI, it's traditionally measured on a year-over-year basis. Because nearly a year ago, we were at almost all-time high level, or high levels for this cycle, 9% on a year-over-year basis. Now we've come down to being up only 3%. So we are coming over the top of probably the worst in terms of rate of change, but prices are still getting more expensive, just at a lower rate.
All right, so now we've got up a chart of the fixed housing affordability index. And just what I'm noticing here is that it's a bit at a low for going back 10 years. Yeah, it's at a 10-year low.
Yeah, even looking at the max length of this, we're at the lowest point in housing affordability going back to the 1980s. And housing affordability, it's looking at home prices combined primarily with the cost of a new mortgage, interest rates. And so home prices have stayed relatively high, interest rates have gotten higher, and so affordability has gotten lower. In the last quarter, we saw mortgage rates rise again. In fact, we hit about 7.5% on an average for a new 30-year mortgage. That's a big change from what we saw a few years ago. It doesn't necessarily mean that, so I think people going into buying new homes now, it's impactful, but doesn't mean that they're necessarily going to own that mortgage for the next 30 years. Right? Sometime in the next 30 years, there certainly could be a possibility, an opportunity to refinance into a lower cost mortgage, lower interest rate mortgage.
Right. I've got a chart here, U.S. credit card debt, and it looks, I'm looking at the 10-year, last 10 years, and it's a high.
Yeah.
How does that relate to that kind of consumer sentiment chart we've got here?
Yeah, I mean, in terms of, so credit card first, the fact that it's gone higher, a few things. One, inflation's higher, everything's more expensive. People's savings from what occurred during the 2020 when the pandemic first started, right? The savings that they had then and or built up over those couple of years after that or year after that, right, is starting to get spent down. And so spending habits and patterns are what they are, and so people appear to be looking more to credit cards to kind of continue to consume to kind of make up the difference. So seeing credit card balances going higher, not great. The caveat, though, too, is that if we were to overlay on here, for example, the size of the economy, right? The economy has gotten bigger. The economy has gotten larger in terms of, so in absolute, by itself, it's a bigger number. We're at all-time highs. but we could also draw a similar line to show that the economy is larger than it used to be, right? Sentiment-wise now, if we just shift over to look at sentiment, sentiment, something we watch a lot because typically when sentiment's low or at its lowest, going forward, stocks actually tend to do pretty well. People feel really lousy about whether it's their job, their overall situation, their outlook on the future. That's actually when stocks actually tend to do pretty well after that.
Yeah, let's talk about recession, right? So the R word. I know that recessions are backward looking, right? So we don't always know that one has occurred until it's sort of defined for us some months later. Mm-hmm. We may very well be living in a recession now, that'll be decided at some future point.
Right, coming into this year, coming into 2023, many economists were predicting that this is the year of a recession, right? And so if we were following that and saying, okay, a recession's coming, it must be bad for the stock market, let's get out. Well, this year thus far has actually been pretty good for stocks. And so trying to time the market and timing recessions, not a great practice in our view.